Good evening, everyone, and welcome to April's Property Millionaire Zoom. So, for those of you who recently joined this community, we do once a month in person, which is in Sittingbourne here, and we have a room, sandwiches, and people come and mingle, as well as we have speakers. Sometimes we do exercises or we do group work together because it's a billionaire. That was the initial idea from the beginning. So we sometimes do sort of share problems and get to some solutions. And if you're joining us for the first time, we have a wide variety of people on the Zoom, and the Zoom is once a month as well. So on the first Wednesday of the month, we have it in person, and on the third Wednesday, we have a Zoom. Lots of different information on the Zooms, lots of different information on the room. There's also a WhatsApp group for free that you could join. You probably got this information from there too about this event. Yeah, everybody's welcome. So I'll just quickly introduce myself, and then we'll go to Paul and then Clive, and then we'll go through the main event of today. I don't want to take too much of the time this evening to sort of introduce myself. Many of you have met in person, and we have conversations either on WhatsApp or on the phone as well, or on Zoom. So I've been a property investor for over 35 years here in Kent, in Sittingbourne. I also have a portfolio of buy and hold properties in Stoke-on-Trent. In Kent, we cover from Dartford to Dover through our estate agency. So we have an estate agency here as well, which is where I am here. This is not a back screen. It's actually the office that I work from every day. We're into developments, and we've done commercial conversions and various other things. So lots to do with, we've got HMOs here and in London. So lots of different, we've tried all the different strategies, title splitting, which we're currently doing at the moment, buying the freehold from a freeholder in order to increase the value so that then we don't have to, when we want to issue our own leases, we can issue our own leases without having to pay lots of money. So yeah, lots and lots of different strategies, putting them all together is really, really important. And they allow you to see opportunities differently, as in you can see more opportunities more often because you've tried different avenues. Thank you.
Paul Merrick, been in business for over 40 years. Started my first business when I was 15, got into the property sector just over 3 decades ago as a property developer of both residential and commercial property. Currently in the process of selling up our debt-free portfolio that we built up over 3 decades of residential and commercial property, as I spend more time being an angel investor and a business consultant. Been a business consultant to large PLCs, I've been a business consultant to regeneration agencies, been a business consultant to medium-sized businesses, and solopreneurs. Spend a lot of my time these days with solopreneurs, either helping them start their business or take it to the next level. There you go.
Brilliant. Thank you, Paul. And thank you for being here this evening as well. So I'll come on to Clive. I've followed Clive on social media, as well as he's got a WhatsApp group, which is fantastic. He's an accountant by profession, but he does a lot of training. And that's why I thought I'd reach out to him, because the thing is, we spend a lot of our time as investors, business people, maybe looking at finances from a borrowing point of view, but looking at the accounts and the end results and being able to understand them and see where the value is and seeing where it can be tweaked and everything else. That part is so important. And I was telling Clive the other day on that in the beginning, because I had an accountant who was elderly and he used to work from home. And when I first started, he went through a lot of my accounts with me to explain everything. And that was very, very beneficial, and it stood me good stead also. But looking to gain more knowledge, like I think most of us are. So Clive, I'll pass over to you. So Clive's going to do maybe 45 minutes to an hour, and then there'll be question time. So please save your questions until then. If you want to put them in the chat, then we can pick them up when Clive has finished. But we'll share the screen with you, Clive, and then the floor is yours. Thank you so much.
So thank you, Sunil, for asking me to do a presentation. I will introduce myself a little more detail at the end, but I just wanted to maximize the time that I had to actually go through some slides with you. But I have been an accountant for getting on to 40 years and also a property investor for about 20. I've got about 12 topics that I want to cover tonight, and they're really, I think, topical tax tips in the main. Some I'll just spend a couple of minutes on, but a few maybe just a little bit longer. I really want you to be aware of these topics rather than learn them in detail on a session like this, and we will have time for Q&A at the end. So starting with making tax digital, which is probably the biggest change in the tax system since I've been around for nearly 40 years. So why is HMRC introducing this? When will it apply to you and will it apply to you? Can you even get out of MTD once you're in? What does it mean to you and how can you help yourself? So HMRC are doing this because they believe that it will reduce errors and increase the amount of tax that the Treasury gets. I think they're probably paving the way to quarterly or even monthly payments. They want you to know how much tax you owe sooner rather than later. And it brings us into the digital world and e-invoicing, which is something scheduled to come in 2029, when all companies that issue invoices will have to do so digitally direct to their customers' software. So when could it apply? Well, if your gross income in 24/5, which ended over a year ago, was over £50,000, then you're already in it from about a week ago. If last year's gross income was 30,000 to 50,000, then you're in it from next April. And between 20 and 30,000, you've still got 2 years to go. How can you get out of it? Well, there's only two ways: cease the income or die. So what is your gross income that's assessed? It's only your gross income from self-employed and property income combined. It is not the profit. It is the gross income before deduction of fees and any expenses. Gross income does not include wages, dividends, and interest. And I'll say again, only includes self-employed income and property income. It doesn't apply to limited companies. I will say that in a moment on a slide. It does not apply to limited companies. So your property income is from property you own personally. If you're in, you'll have to submit quarterly figures of income and total expenses, and depending on the level of your income, your expenses will have to be broken down. For anyone who's done a VAT return, it's actually not dissimilar. You will still do an annual set of accounts and a self-assessment. I'll just mention penalties. There's going to be penalties for late submission, but they are not going to charge that for the first 12 months. However, they have not said that they will not charge penalties for failure to register and failure to keep digital records. And failure to keep digital records is £3,000 per quarter, per business. So if you have 2 or 3 self-employments and 2 streams of property income, your fees could be tens of £20,000, not fees, penalties, could be a lot of money. Digital records means that you keep a digital record of every receipt and every payment. There are some exemptions for businesses like retailers who can keep a daily till roll. You do need to keep your invoices and receipts, but that's the same as you've always had to do. Digital records will have to be prepared on accounting software like Sage, QuickBooks, Xero, etc. You can use Excel, and Excel is perfectly adequate. But in order for Excel to talk to HMRC, you will need bridging software. It just communicates with HMRC. And I'll just stress again, it is not applicable to limited companies and partnerships, and there are no plans for that to change. How can you help yourself? I've always thought it was important to have a separate business bank account for every self-employed business and for your property businesses. I think it's even more important now. Digital records, you don't using bank feed with software like Xero. You don't want all of your personal receipts and payments being exposed to the tax man or to bookkeepers. So start now. Register for Making Tax Digital. Get your software ready, get your systems ready, and get your support ready from your accountant. Just a couple of points specific to property. It'll become very important to track income and expenses to each and every property. And the reason for that is that you may own a property. You may own 10 properties, let's say. You may own 3 in your own name. You may own another 3 with your spouse. You may own another 3 with a friend, a JV partner or a friend. And you may own the last one with yet another friend or somebody like that. And you may own them in different proportions to 50-50. And of course, with your spouse, don't forget you can allocate a change of beneficial income. So it will become important to track income and expenses, and programs like Zero use tracking, like it's almost like project management. They can track income and expenses to each and every property. Unassigned income, your general overheads like your telephone, office expenses, they can be unassigned. Let me just stress one thing that I didn't put in the notes. I did say that you will have to do quarterly submissions for each and every self-employment that you have. So if you are a joiner and a business consultant, it's possible, unusual, but it's possible, then that's 2 businesses. For property, you can only have 2 property businesses at the most. One will be all your UK property and the other will be all your non-UK property if you have any. So to stress again, you can only have one UK property business and you will need to submit. This is for submission purposes. You can have as many as you want. I'm talking about for Making Tax Digital. So you will submit for all your UK properties just one amount for income and one amount for expenses per quarter. So finally on MTD, put away the pen and paper, try and kick the Excel habit and embrace integrated software. I would not be attracted by cheap or free alternatives. A lot of the banks are now including with their banking free systems that purport to analyze your expenses. But my honest advice is for what little they cost, don't reinvent the wheel. Use the market leaders like Xero, QuickBooks and Sage, or even Free Agent. They'll cost you between £15 and £30 per subscription. Some a little less, some a little more if you've got VAT and payroll, but they're not expensive and they do a great job. If you want my honest opinion, I'd probably go with Xero. If it just helps you make a decision, I'd go with Xero, but any of them are really very good. So moving on to the second topic now, and small businesses, non-limited businesses do not have to prepare a balance sheet. Most accountants, therefore, don't bother to prepare a balance sheet. But I think a balance sheet is very, very important, especially, in my opinion, for property businesses. Again, I'm talking about non-limited because limited do have to keep a balance sheet. Now, the reason why I say this is, and I'm going to use an example of this, I'm sure you'd agree with me that if you pay an expense out of your bank account, it is very most likely that you will include that as an expense in your accounts because it's hard to miss. It's on your bank statement and your accountant or bookkeeper would have to do a really bad job to miss it. It's possible, but unlikely. How many of you have taken out mortgages and had to pay £1,000 or even £3,000, £4,000, £10,000 for the mortgage arrangement fee? And very often the lender says to you, we can ease your pain. You don't have to pay the arrangement fee. We will add it to the loan that you owe us. Of course, they want you to do that because then you increase the loan and you pay them interest. But it's good for you as well because you may not have £5,000-10,000 to pay out a fee, and you want to use the maximize your equity to buy property. How many of your accountants who do not prepare a reconciled balance sheet will forget to the mortgage arrangement fee as an expense? I've seen it. There's somebody on this webinar who will obviously remain nameless, who recently told me she's found nearly £80,000 worth of fees that have not been claimed over the last few years. And that's quite shocking. I've also had one recently where the figure was in excess of £60,000. So there is one other thing. It's very unusual that you can actually get double tax relief. The system doesn't usually allow that. But if you were lucky enough to have a holiday let or a serviced accommodation or commercial property up until 5th of April 2025, you might well have claimed capital allowances. But don't forget, in addition to capital allowances, when you come to sell the property, if and when you do, you can also claim the original costs against the capital gains tax. So you might well enjoy two lots of tax relief: capital allowances on the purchase of the property and capital gains tax relief when you sell it. If you don't have a balance sheet, I think it could be very possible you will not claim the second lot when you come to do the capital gains tax, or at least if you do want to, you may simply not have the figures available 10, 20, 30 years later. I'm going to look at the third topic now: property disposals. This is personally owned property. I repeat, personally owned property, and not property owned and sold by a limited company. If you sell such a property, you have to report and pay the capital gains tax within 60 days of disposal. I know from my own experience and from talking to people, so your conveyancing solicitor won't do this for you. The really bad thing, and I think it's really, really bad, is that they don't even mention it to you. They don't even say to you, you know you've got to do this. Do you know anyone who can help you do that? By the way, I put a question mark after the word partnerships. There's actually no such thing as a property partnership. A husband and wife may own properties jointly, but they own them half of those properties each. You cannot own a property in a partnership. And I've seen people do partnership accounts for property businesses. It won't get you into any trouble. It's just not necessary. So very quickly, because this is long established, just to remind you though, when you come to sell a personally owned property, you deduct from the sales proceeds fees that you have incurred, and that's what we call the net proceeds. You then take from that the total cost. And don't forget, the total cost is the original purchase price of the property, plus any stamp duty you paid, plus the legal fees when you bought the property, plus the capital refurbishment costs. I think I've got a slide on capital and revenue costs towards the end, but very briefly, just in case I haven't, capital refurbishment costs are very simply those that improve the property, whereas revenue repairs are things that maintain the property in the current condition. You should be claiming revenue repair costs against your income every year, but you will only be able to claim the capital refurbishment costs against capital gains tax when you come to sell it. Capital gains tax at the moment is at the rate of either 18% for basic rate taxpayers or 24% for higher rate taxpayers. Very important because a lot of people own investment properties for 10, 20, 30, 40, 50 years. They may even pass them on to children and grandchildren. It's really, really important to keep the original completion statements, plus any details of refurbishment costs, legal expenses, And I would suggest keeping a series of photos of before and after. And the reason why I want you to keep these invoices and receipts and photos is that if you claim £100,000 or £200,000 worth of refurbishment costs and the taxman says, "Can I have a sample of those invoices, please? Can you prove that you improved that property?" Well, without photos and receipts, you can't. And I have relied on photos in the past. I once relied on a copy of the estate agent's photo, the photo they put in the windows when they sell properties and you buy them. I had to find a copy of one of those because it had photos on it. So really important. Let's move on to tax allowable expenses and tax-free benefits. We all like this. 99% of allowable expenses are based on the what we call the wholly and exclusively principle. If you have incurred an expense wholly and exclusively for the purpose of the business, it is deductible. There are three key words here: wholly, exclusively, and for the purpose. The purpose of a business would be generally to generate sales, to find properties, to gain rental income or guest income, etc. Wholly and exclusively for the purpose. So if you go away for the weekend and you have 2 days sunbathing and 2 days work, there is a question mark there whether it's wholly. And I mean wholly with a W. So there is a question mark whether it's wholly. Most people would either claim it in full or apportion it 50-50. I wouldn't blame you for apportioning it 50-50. I think the taxman could argue the point because it's not wholly and it's not exclusively. There are a few allowances and benefits that are based on rules and regulations and not the wholly and exclusively principle. There's the use of home allowance, and you can claim £3 a week, which is barely £162 a year. Tax on that at 20% is barely 30 quid, 60 quid at higher rates, so not a lot. But you don't have to justify it. If you do a minute's work at home and claim that, nobody can argue with you. You can pay trivial benefits, non-cash. It can't be in cash. It can be up to £50 a month. It can't be a penny more. The £50 does include that. Directors are limited actually to £300 a year. If you employ people, I would suggest that you do things like birthday gift, holiday gift, Christmas gift, employee of the month, things like that. I wouldn't do it 12 times a year. That looks a bit up for each employee. That looks a bit obvious. I'd do it 6 to 9 times a year. The reason why I say you don't want it to look obvious, even though it appears to be an allowance, it can't be contractual. It can't be as expected by the employee. It can't become a habit. And therefore, you need a reason to give the to give the trivial benefit. And I would say do it a little more randomly than monthly. Do it 8 times 1 year, 9 times another. Do it for birthday, anniversary, holiday, Christmas, Easter, employee of the month. You could also have a party allowance for Christmas, which is £150. Forgive me, I can't remember if that includes VAT. I think it does. And you can also have it for a partner to come to the party as well. Let me just move to the next slide. Okay, one of people's very favourite questions, to be or not to be, as Shakespeare asked, not about whether he should become a limited company or not, but we do ask that question today. Actually, there's not a lot of tax difference between the two, between taxing and I. There used to be, going back 15 years ago, you could save upwards of £10,000 on fairly modest £50 to £60,000 profits, but you can't now. The difference is literally from pennies to a few £100s. I think you need other reasons to go limited, and there are in property. People like limited in property because of the insurance risk, the risk of losing a property if you're sued, and other things. And I think there are genuinely good reasons to be limited. even though the saving really is quite trivial. There's also very little difference nowadays between low salary, high dividends and high salary, no dividends. Very little difference. So much so that I tend to advise clients to have salaries these days. And I do that for two reasons. One is it means that they pay the tax and NI on a monthly basis and don't have an annual tax bill to pay. And that helps them manage their affairs much better. Note that I highlighted the word low salary and haven't put no salary. I have not put no salary. I'll repeat that. You should always consider taking at least a low salary, even if you do prefer dividends. And the reason for that is that you have to have, again, forgive me, I can't remember if it's 30, momentarily, if it's 30 or 35 complete years for NI purposes for to receive a full state pension. And a low salary, as long as it's, the figure is just around £5,000 a year salary, just over nearly £500 a month, and that will entitle you to what they call a full year's, in the old days we used to call it a full year's stamp, if anybody out there can remember that. But your state pension record is stamped for a full year if you have a minimum salary. So always good to take a small salary. The other things to look at are you using your personal tax-free allowance of 12,570? Have you used up all your basic rate band? And I think when it comes to property, one of the golden rules for me is, are you in growth mode or are you in income mode? If you have enough income to live on and want to park the money and not pay any unnecessary tax on it, then park it in a limited company and pay 20 up to 25% tax on it. But that can grow in the limited company to buy more property. If you need the income, it's probably better to not have that in the limited company and pay company tax and then pay tax to take it out. So are you in growth mode? Limited company. Are you in income mode? I would suggest, are you in growth mode, limited company? Are you in income mode? I would suggest personal ownership, at least up to using your basic rate band. Okay, yeah, this is a good one, but Sunil, would you just tell me that I'm still being heard?
Yeah, you're very good. Thank you very much. It's all good and clear. Thank you.
Thank you for that, Sunil. Okay, yeah, this is interesting and applies to self-employed businesses as well as potentially to to property. Firstly, you may have to register VAT when your gross income is £90,000 or more in any 12-month rolling period. That's not an accounting period. That's a constant rolling 12-month period. You can voluntarily register for VAT at any time. Now, why would you voluntarily register? Nobody likes that. But actually, some people, it's useful to embrace it. And sometimes you have to embrace it, of course. You might register voluntarily if it doesn't affect your customers. If all or most of your customers are VAT registered and can reclaim the VAT you charge them, well, they're no worse off. But you're better off because you can reclaim the VAT on your expenses, so you're better off. But you could also consider using the flat rate scheme. Now, the flat rate scheme, I think I have an example here. I do. If your sales are £20,000 plus VAT of £4,000, which is £24,000 gross, and your expenses are only £4,000 and the VAT on that is only £800, then your net VAT payable will be £3,200. Now, I can't register for the flat rate scheme because an accountant, when I look on the list of flat rate scheme percentages, the last time I looked, an accountant was 15.5%, although I've used an example here of 16. 16% of 24,000 is 3,840, 3,840. So I would be worse off if I did this and I had an accountants were were on the list at 16%, I'd be worse off by £640. But if I was lucky enough to look on the list, and I've got a client who's a photographer and his percentage is 10%, a very nice low figure of 10%, he only has to pay £2,400. So he's actually £600 better off per quarter. So he's laughing just by registering for VAT and using the flat rate scheme. Now, in property, we know that buy-to-lets cannot ever register for VAT. Rent on a buy-to-let is exempt, can never be applicable to VAT. But we do know that holiday lets do attract VAT. Are standard rated supply and therefore may have to register for VAT. And I don't know how many of you out there know what the percentage is applicable to holiday lets. It's a very tasty percentage of just 10.5, which is a great figure. So, incidentally, you get a 1% discount for the first year you're on flat rate schemes. So my friend, the photographer, is on 9%, and the holiday let people are on 9.5, not 10.5. One other thing to remember when you register for VAT, whether it's flat rate scheme or not, you can claim back the VAT on your expenses for 6 months prior to registration on most services. In fact, the only services that you can't claim it back on, it's a specific exemption, is energy, heat, light, and power. There's one or two other weird exemptions, which I can't even remember. I've never come across them in practice. But the only one I know of is heat, light, power, utility bills. You can also claim back on all capital costs up to 4 years prior to registration. We talked about capital costs before when I talked about capital refurbishments or revenue repairs. Capital costs could be or would be computers, potentially building costs, where they were capital expenses. The problem with buildings is that builders supply a service, and that restricts it to 6 months. If, however, you go to B&Q yourself and buy the stuff, then you can go back further. But a builder who supplies building services and materials as well as labour is providing a service, and that's restricted to 6 months. Incidentally, just for the sake of completion, even if you're on the flat rate scheme, if you incur an expense on a capital item of £2,000, including that, which is about 1,667 plus that, like on a computer or something like that, or an office furniture photocopier, then you can still claim it back even on the flat rate scheme. And that's not retrospective, that's ongoing. You can only deregister when your income, your sales goes under 88,000 in the rolling 12 months. You can register for a flat rate scheme until your sales exceed 150,000, excluding that. So that will cover most holiday lets. In fact, usually up to 2 holiday lets. But some are much bigger. And there's a big gap before you have to actually deregister. You can stay registered once you are registered until the sales exceed 230,000, including that, which is a fraction under £200,000. So there's a little bit of a margin there before you have to deregister, and 230 would certainly cover most small businesses, holiday lets and serviced accommodation. Yes, I have got a slide on capital and revenue costs. There's a critical difference, although actually it doesn't make an awful lot of difference to tax, and I'll explain why. I've already said that capital costs is money spent on something that will benefit, excuse me, a couple of spelling mistakes, that will benefit the business for more than 12 months. Capital costs are added to fixed assets on the balance sheet. We've talked about the balance sheet. But even if you can't claim those capital costs, there's a chance you can claim capital allowances, and certain capital allowances are available at up to 100%. So a lot of capital improvement, capital expenditure is tax relieved in full as well. Although in property, as it happens, it's where there are some exemptions to that. And capital allowances are restricted on certain aspects of property and property improvements. As I mentioned at the bottom, there are some restrictions on improvements. Obviously, the difference is that revenue expenses, and always think of revenue expenses with the two letters redecorating, repair, carpet and maintain, just renew. Anything that you can put the prefix RE in front of is usually a revenue expense. And you can deduct that from income in arriving at taxable profit in full every year. Very important aspect here, very complicated area as well, and I'll only really be able to make you aware of it. There are two very valuable reliefs. Business property relief, BPR. There is an agricultural version of that called APR, but I've never had a farmer as a client, so I don't really know much about it. And business property relief is something that can relieve up to 100%, up to first £2.5 million or 50% after that, and can give you relief from inheritance tax. BADR stands for Business Asset Disposal Relief, which is the new name for Entrepreneurs Relief, which in itself was the new name for, it's just gone, I'm sorry. Entrepreneurs Relief was a few years ago, and the name in between has just escaped my mind. But that gives you relief at up to 100% against capital gains tax. As I said, that there are some quite complex rules, but the main point I want to make, and the main aspect that affects property investors, is that it only applies to trading businesses. It does not apply to non-trading businesses. And unfortunately, property investment businesses, by virtue of the word investment, are not trading businesses. I think that if you had a business that bought and sold, a flipper, if you were a flipper and bought and sold, I think you would almost certainly be established that you are trading. You're buying and selling and you're trading. You are not investing. I don't think there are many property businesses that can ever claim that they are trading. I don't even think that holiday and service accommodation can. The only time that you can approach being able to justify calling yourself trading is probably when you provide the services of, or very close to being, a hotel. And even a holiday let doesn't. Just because you clean once in between lettings, just because you provide a hamper, washing machine, and some brochures and a bit of this and a bit of that, you're not providing things like breakfast, lunch, dinner, external tours, and taxi services and things like that. And I think that's a problem. It's unfortunate, but you do need to know that if you can establish trading in any of your businesses, then you really have got a great opportunity to get a substantial tax relief. Estate planning, really, really important. It's so easy to not think about what your purpose is. Your purpose running a business is to maximize your current wealth, the current wealth of your immediate family, to enjoy life to its maximum, to leave a maximum legacy, to be able to retire early if you want to, but whenever you want to, and to enjoy your retirement. And if you don't think about that objective and plan for it early on, certainly in terms of your tax, you will waste a lot of tax. There is actually no reason to pay inheritance tax or capital gains tax. There's virtually no good reason to pay capital gains tax or inheritance tax. It does require a lot of planning. It does require a level of trust in a way, because parents will have to gift their capital assets, ideally up to 7 years before they die. But although they can't enjoy those assets and the income, they can to some extent keep some control over it. Property, I think, is one of the best ways to exploit estate planning. If, for example, you've got a limited company with some properties in it, you can make your children shareholders. You can give them a secondary class of share. So you and your partner, you and your spouse, or just yourself, will have the ordinary shares, the voting shares that will give them entitled to control the company and to take dividends. You could give your children B shares, which only entitle them to the growth, I repeat, the growth on the value of the property from the day you give them the B shares. And if you do that early enough, if you feel able to do that early enough in terms of your own income and wealth, you can pass on the vast majority of the growth, which after all, after 20 or 30 or 40 years, when your property has doubled every 10 years in value, you are giving away most of the growth, which means you are giving away any chance of paying inheritance tax on that gift to your children. I did say that you're giving them the growth. You could give them the shares now, but that would mean that you've then got to survive 7 years and you're giving up control of the company and the right to income. So most people issue B shares, often called growth shares. There's no such thing as growth shares, but people know them as growth shares because it says on the tin what they are. They're growth shares. You can use different classes of shares, incidentally, for different strategies, but that's probably the most popular one. I did talk originally about you're here to maximize your wealth. Business success, maximize sales and income, minimize costs and expenses, therefore maximize profit. Reduce tax on profit by claiming all conceivable allowable expenses, all reliefs, and maximizing tax-free benefits, which we talked about. Estate planning to mitigate CGT. Well, and IHT, I've talked about this. Gifting assets well in advance of death. Using trusts. I haven't really got time to talk about that. Very complicated area, trusts, but can be extremely useful for large portfolios, for wealthier clients with children or grandchildren who don't want to give control to those young people, some often under 18, when they can't even do a tax return or earn their own income. Sorry, I think it's under 16. So just bear in mind, when you're talking about estate planning, think about trusts. Complicated, a little bit expensive to set up and administer, can be useful. I'm not really going to dwell on this. It's just an alert. Most of you have done it by now. Companies House have got a new system requiring you to verify yourself and getting a personal ID code, which you need to use when you set up a new limited company or submit a confirmation statement. So I'll move on from there. A personal slide, working with professionals and non-professionals and professionals, lawyers, accountants, etc., non-professionals. And don't forget, please notice, I don't use the term non-professionals here. I think we should always aspire to work with professional people, even if they're not part of what's called the professional trade. The professions like doctors, lawyers, dentists, accountants, etc. So my comments here are: agree everything in detail and in writing. Agree any adjustments in writing. Monitor progress. Communicate regularly and clearly, and set timelines for progress and payments. And that's not just working with builders, even though it sounds like it is. Demand that your lawyers, solicitors, accountants, surveyors also tell you what to expect from them and deliver on your expectations. Remember, you only pay for what you get and you get what you pay for. If you squeeze someone so hard on price until their eyes water, if they still want to work with you, I would say you should probably not work with them because they've allowed you to squeeze them that much that it hurts. And if you do, will they deliver on time? Will they deliver on budget? Will they deliver on quality? It's up to you. We've all got our personal ways of doing business, but I think in my experience of over 40 years, and I know most of you on the call have got a lot of experience, and you probably agree with me, some are younger people, you pays for what you get. Okay, so I'm just going to close that. So here it is, drum roll for my number one tip, and it probably will surprise you because it's not really tax or accountancy, but it is connected, especially to estate planning. My number one tip, ladies and gentlemen, is have a will. To have a will and to also have people be your attorney for what we call power of attorney, so that if anything happens to you, and sadly, it will happen to some of us. Some of us will die early, but more than some of us, sadly, will become incapacitated in some way. For God's sake, please have power of attorney. My best friend has been in hospital for 5 years, will never come out, and will never, ever live any sort of normal life. And his wife has done the most amazing job for him for over 5 years. She fought through the courts to get control of his affairs. It took her nearly 5 years. You must have a will. If you don't, the Treasury will get your money. If you don't have power of attorney, your children, not you, your children and grandchildren, your wife, your partner, your friends, your family will have a nightmare if you become incapacitated. That's my number one tip. So I'm going to just flip ahead, if I may, before I just invite Q&A, and just very briefly show you the slides, just a little bit about me. In blue is the personal stuff. In black is the professional stuff. So I've got a lot of experience. I've got a lot of clients generally, and a lot of clients, and about half of my clients either have property as a side investment or as a full-time business. I'm systems crazy and strongly believe my practice should focus on the best accounting packages, probably Xero, but any of the major systems. I do think that that people in business should have a bookkeeper do their or their accountant do their books. In my opinion, it saves time, stress, and money, because there's nothing harder than sorting out a mess. It's often easier to start again. Think of the cost of building a house from the ground upwards. Far, far, far cheaper than refurbishing and gutting and refurbishing a house. And that's the mess sometimes people make with their books. It's also my principle of delegation. Don't waste your time not doing what you're best at. I offer a proactive service, the usual sort of stuff, the usual sort of cliches, but I think it's true. I hope it's true in my case, and you can contact me. I'll put that slide on at the very end, but really I'm going to come off sharing the screen to see you and to invite anybody to ask me a question on anything, and what we've spoken about, or perhaps what we haven't, and I will do my best in the time we've got to answer or follow it up afterwards. So please go ahead.
Thank you so much. Really, really great. Lots of great. These are all indicator when the number of people stay on through the presentation of how good the speaker is, because if it's not good, they'll go, oh, yeah, I'll go and make a cup of tea, or they'll leave. We've had 40 people all the way through.
Thank you very much, Sunil.
Good evening, everyone. Hi, Summit. Clive, thank you for your presentation. Really enjoyed that. Thank you. Just a quick question regarding gifting properties to your children. Are there any restrictions in the parent or the gifter living in the property before they pass? I'll put it in the chat as well.
No, there's no restrictions. So you can give your personal home or an investment property that for whatever reason you have lived in, that's your asset and your asset to gift. If it is your personal home that you're gifting, then potentially that, it's unusual of course, but potentially because of the principal private residency rules, that could be exempt. But you would want to change your principal private residence to your new property to keep that, because it is still the single biggest tax allowance, and God forbid that should ever be changed, and it was talked about or rumoured, but that would change. But it's still a huge tax saving. So no restrictions on that. No.
Perfect. Yes,
I
thank
think
you.
the question in the chat. Sorry, I think the question in the chat that something put on there, I'll just clarify, and something come in if you need to. Can you gift the property to your children and also live in it? So is this the restricted benefit situation?
You can't. Yeah. Okay. Before you, and also live in it. No, I took from Summit that it was a house that he'd lived in, and I've answered that. But you certainly cannot continue to live in it from an IHT point of view, because you are, what they say, retaining an interest in it. You have gifted it, but you haven't really, because you're staying in it. What some people do in extreme circumstances is they do carry on living in it, but they pay a full market rent to the children to continue to living in it. So they are not retaining any benefit from that property. So you certainly can't gift it for IHT purposes. And it's not a gift. You haven't given it away if you retain an interest or benefit in it. So it can't be a gift if you stay in it.
Thank you for clarifying. Clive.
Okay.
Perfect. Perfect answer. Thank you.
Thank you.
Great. Thank you. Jane has asked a question. Tax relief on a property you use as an office. How much of the property is used as an office and how much do you live in? That may help Clive to give you a better answer.
If you work from home, or even do a little more than that, you use the garage as a workshop and all that sort of thing. Can you claim an allowance against tax?
Thank you so much, Clive. I really appreciate all the key tips and points and the takeaways that I've
Yeah.
managed to gain from the webinar. My question is more so around, if I had a property, for example, that I was utilizing predominantly as an office space, and I also use it as like a training facility. But say, for example, one of the rooms, somebody stayed there temporarily or momentarily, but it's predominantly an office space for a training facility. Could that be used? Could you claim tax relief on that? And then for the period of time when someone stays there, would you just then have to submit that that was for personal use?
The property is basically a commercial property. You could even imagine the very common situation where you've got an office or shop on the ground floor and what they call uppers, which is usually a flat, one or more flats on 1 or 2 stories above. Property that would be apportioned. And there would be a commercial, most of that property would be commercial, and the rent on that would be a commercial rent with commercial expenses, and the little bit that applied to that was made to look like a bedroom with a bed in it and a wardrobe and bits and bobs like that, that would be almost like a little sublet part of the property. And I think you would just do property accounts for that little bit.
Okay, that makes sense. That's really helpful. It's because, for example, I run a care home, but I would utilize a property as a training facility for some of the staff. But obviously it's not going to be utilized on an everyday basis. So I may have a tenant there on
I certainly think you've got opportunities to mix and match that, and a care home is in its own right a little bit different to just buy-to-lets and even HMOs, because they are sort of trading. They're not a hotel, but they're offering a different level of service if it's a full-blown care home, as opposed to a house that's just been let long-term to a care provider. I think there's a bit of a difference there. So I think you certainly have opportunities there to to claim all of the expenses and to split that up in that way. But really, in a way, you could say, does it really matter? Because the total income from both aspects of the income and all the expenses, the profit would be the same, the bottom line, whether you split it up or not. I'm not saying you shouldn't split it up. I'm not saying you shouldn't have to split it up, but actually, I'm not sure it makes that much difference, really.
Yeah, you're probably right. Thank you so much.
There's a question
Yeah,
here, I think,
question.
about B shares that's just come in. Would it be more efficient to hold the property within the company structure rather than a personal ownership, particularly when considering future refinancing? It's probably a better question for a broker, but most of us on here have got some experience with getting lending, whether we own things personally or in a limited company. My experience and the experience of all the people I know investing in property is that there's no real restriction on getting lending, whether you own that personally or as a limited company. Lending on investment property is not based on your structure, or is not based on your personal income. It is based on the quality, or the value, should I say, of and the purpose and use of the investment property you're buying. And the surveyor and the lenders will ask you what you're going to use it for, will want to get a valuation of, will normally lend around 75%. There is a restriction on your personal home, because that's a personal home, and your ability to afford that home depends on your income, your employment income, self-employed income, or a combination, because they won't lend on a £1 million house if your income is maybe only £25,000, because they don't think they could, and you can't afford it. But lending for an investment property is a business decision based on the lender's view of the profitability of that. There was a time when limited companies were charged a little bit more, maybe up to 1% more interest rate. My experience of that is that differential is all but, if not disappeared. I hope that answers that question. If you have property investment company and you wish to add your children on B shares, is this at a family investment company? It's a good question. A bit like I said that growth shares don't exist. They're called B shares, but we like to call them growth shares because they say on the tin what they are. There's actually no such thing in law as a family investment company, an FIC. So don't be conned by people who charge £2,000 or more to set up an FIC when it only costs £100 or to £200 to set up a company. A family investment company is really a company that's being set up for a family, whether it's a husband and wife, or man and partner, partners and their children, to buy, to invest and buy investment properties. Yes, it is true when children become involved, it's common to use B shares. And that's because the adults, usually the parents, still need their time of life to enjoy the income. That is their job. That is their income. That might be their pension. But they don't want the capital growth, because they don't need it. They've already got their house. They've already got maybe their holiday home, other things. They don't need capital. They need the income. And they're quite happy to pass on the growth to the children to enjoy when they, shall we say, inherit the business and the assets.
Can I get my son to pay for the mortgage in the house he lives in? I'm not sure if that's a family question or what, which belongs to me. So that the property belongs to the person and their son lives in it. And the question is, can we get them to pay the mortgage?
I mean, if my son who lives in the house was generous enough to say, "Dad, can I pay your mortgage for you?" I'm not being flippant with the answer, because I think that is the question. My lender, my son, is gifting me money. He probably is, but he's probably he's not worried about inheritance tax at his age and with his asset value, unless he's lucky to already be a very wealthy young man or young lady. And it's probably, if he's paying your mortgage for you, a gift out of income, so wouldn't be potentially taxable in inheritance tax transfer. So yeah, I think your lender doesn't care who pays you, if I'm honest.
Hi, great. Thanks very much. Yeah, so the question is, so if we're taking borrowing from our residential, our primary place of, of residence to use on to refurbish a property that we bought in a company, how do we then get our company to pay us back that money?
Okay, it's a great question. And I thought you were going to ask something very slightly different. So I'm going to answer both questions,
Please do.
even though it didn't. If I borrow money on my house and lend it to my property company, so my personal money, I lend it to my property or my accountancy or any other company I've got, I give it, I lend it, so I lend them £100,000. That is a loan they receive, that company receives. It's not income. The company doesn't pay any tax on getting that loan money in. It becomes what is called a director's loan account. And at any time that company has the money to pay me back, and you as the director want it to pay you back, it can pay you back, and you could even then say, I'll repay the mortgage on my home. We did it for a purpose. We did it for short term, medium term, long term. That purpose has now ended. I'll take the money back from the company. I'll either buy a holiday home or a Ferrari with it, or I'll pay off the mortgage that you raised. I hope that answers your question, Charlotte.
It does, yes. And then from a practical point of view, in terms of form filling, etc., how does that work when we want to get?
When you want to get the money back, I don't think there is any form filling.
Okay.
If you physically transfer from your personal bank account to your limited company £100,000, and a year or 5 or 10 years later or 10 months later, the company physically transfers the money back to you. Just like with any transactions, just record it.
Sure.
Make it clear on the bank statement that's paying it out and receiving it in where the money came from, because 10 years later, it's so easy to forget. Where did we get that £100,000 from? Or if the taxman says, where on earth did you get 100,000? You know, I can't blinking well remember. It's so long ago. You got it from somebody and should have paid tax on it. You know, they've caught you, but you need to just keep that evidence, right? The question I thought you were going to ask is, if I mortgage my house, if I borrow £100,000 on my house because I want to buy an investment property, can I claim tax relief on the interest on the £100,000 I've borrowed? Yes. I can, because it's wholly, exclusively for the purpose of buying an investment property. So if my mortgage today on my home is £50,000 and I pay £100 interest a month on it, if I borrow £100,000 more, so my mortgage on my house now is £150,000, let's say I now pay £300 per month interest. 100 plus the extra 200. I can claim tax relief on the £200 per month that I'm paying to borrow that extra 100,000. It's wholly exclusively for the purpose of refurbishing or buying an investment property.
Great.
That's the question I thought you were going to ask, which is quite popular.
That's great.
Excellent. Thank you, James.
Just a quick one on the same question. Is there a timescale where you have to repay the loan back?
No time scale whatsoever. The limited company, unless you have a contract, of course, unless you have a loan agreement, but between directors and their own companies, there's usually not an agreement, but there might be. You can even charge the company interest if you want. Depends on your personal circumstances as to whether that's beneficial or not. It's a way of getting money out of the limited company. But if you're a higher rate taxpayer, paying 40 or 45%, and the company's only saving 20 to 25%, probably isn't worth it. But no, there's no time limit. It's a loan that you've lent the company, shareholder loan, director's loan, friendly loan. Your parents could give you a loan if they want to, and it can be repaid as and when the company decides to do so, and the shareholders decide to do so, unless there's a contract in place, or a loan agreement, I should call it. The other way round, incidentally, you taking money out of the limited company. So if you borrow money from your limited company, that's a no-no, because you're borrowing it when you are not taking it as wages, which you pay tax on, or dividends, which you pay tax on. So if you borrow money from your limited company, you need to pay tax on that loan, on the beneficial interest. Obviously, as I said before, if you're repaying an existing loan that they owe you, that's okay. But if you're becoming a borrower from your business, you're only doing that to avoid PAYE on dividend tax.
Thank you.
Brilliant. Thank you. So Rachel asked a similar thing. Interest when paying back the loan. So what's the interest on the loan, or what's an average interest on a director's loan, and how do you apply it?
Okay, so if I lend my company money and I think it's beneficial for me to charge interest to the company, then I think you could charge anything reasonable. You can charge as little as you want, so you could charge something trivial like 1 or 2%. Where you have a problem is if you suddenly start trying to use this as a means of getting money out of the company. So you couldn't charge 20%, because you could go anywhere commercially and beat 20%. So I think you could charge anything from 7, 8, 9, 10, 12, probably anything from 8 to 12%, and be very comfortable that you could say, all right, 12%, it's a bit more, but it's no more than a bridging loan, and it's quite risky from the point of view that there's no security on it. Well, actually, that's a bit silly, because it's your own money in your own company. So forget that one. So anything that's commercially reasonable up to a limit, but as low as you want. Hope that answers that question.
Organising what I've got in my brain to make more financial sense, if that makes sense to you.
Does make sense, but I'm probably as confused as you are half the time. Anyway,
got a 3-bed HMO and a 2 flat, and at the moment I'm taking that money personally, and it's about 30,000 a year. I'm living in a house that's split into 2 at the moment, and I'm renovating the downstairs 4-bed as a holiday let. And I've had Sykes tell me I can get £400 a night. I've also renovated 2 rooms in the upstairs that I was going to do holiday let in as well. But I'm also living in the upstairs, and I know you can get rent a room relief.
Yeah, the rental relief you're talking about, just to cover that one off before we talk about the other, is really, it's up to £7,500 for a lodger, and I don't think that you can use that relief if you have it's almost like an Airbnb. If it's an Airbnb and you have different guests coming in for a few days, 1 night, 3 nights, 7 nights, or even a month or 2, they're not a lodger.
Right, okay, so
Is Roger the lodger, and guests on an Airbnb are not that. There is an exemption for the first £1,000 a year, but that's not the one you're talking about. So if you split your personal house up into 3 sections, 4 sections potentially, down the whole of the downstairs, that's fine. Half of the upstairs for another holiday let, and you have the last third. So it's split into 3. And maybe into 4 if you have 1 room for the lodger, then that's the 7,500 tax free. But so the others will be 2 holiday lets, and they will be taxed as holiday lets. Now, very interestingly, if you already lived in it as your principal private residence for the last 10 years, and you don't move out, you will be able to park that. So let's say you've had it for 10 years. Let's say you've had it for 5 years, but you now have it as holiday let for 5 years, and then come back and then sell it. I'm just using a very simple answer. You've still got 50% tax free. because you park the tax-free status of the principal private residence, even if you change its use. So bear that in mind. Do you understand me?
Yeah.
Okay.
It's a bit of an awkward situation at the moment. The downstairs is completely separate. Their own entrance, their own utilities and everything. So that the 4-bed downstairs will be the holiday let really. And
got
the
you.
upstairs is going to
I
be
think it's very common. I mean, a lot of farmhouses, big houses, they do split them that way.
Yeah, Clive, thank you so much. Thank you for this evening. You've been talking for an hour and a half, some fantastic information. Thank you for everyone for joining us and all the questions you've asked. Clive's got his details there. Reach out. You can see there is tremendous value there, and we'll see you on the WhatsApp group, or reach out to one of us or to anybody else, and we will catch up at a property meet.
Absolutely. It's a lovely group to be in.
Clive.
I'm glad to have joined it as well.
Yeah.
Thank you, everybody.
Thank you, Clive.
Thank you.